So the current challenge for all valuers is how to deal with the implications of COVID and the impact on valuations. And Tom and Richard will give you an insight over the next 45 minutes or so without hopefully giving away all of their trade secrets. So I'm going to hand over to them.
Good morning, everyone. Thank you, Sarah. A fabulous introduction. Thank you. We'll try and live up to that. It's good to meet you all virtually, and over the next 40 minutes or so, Tom and I will try and do two things. Firstly, we'll try to keep you engaged, which is quite difficult with accountancy. And secondly, and more importantly, we'll try to give you an edge to help your clients. I will be talking about accounts, and then Tom will be picking up the valuation topics. As Sarah said, we prepared a large number of slides, many of which we will have to skate over given the limited time. But as Sarah's already said, don't worry about furiously writing down too many nuggets. The pack will be sent to you electronically afterwards. Finally, we are amongst virtual friends, so don't be shy about asking questions. For sure, someone else will be wondering the same point, and we'll pick up as many of those as we can at the end. So this is what we're going to be covering over the next 40 minutes or so. Top half dealt with by me, and then Tom will move on to the valuation points afterwards. So a little bit about Creston Reeves. You might not have heard of us. Top 25 firm based in the southeast. 8 offices from London and Kent and Sussex. But we have global reach through our Creston International Network. Tom and I are both forensic accountants, as Sarah mentioned, and we spend a lot of our time doing business and intangible valuations, but also commercial disputes, loss of profit expert reports, and also we do some white collar fraud investigations and confiscation work. So on to financial statements. As a minimum, a set of accounts tells a story about a company's assets and liabilities at a point in time. The amount of funds available to be withdrawn by shareholders by way of dividends is also shown, and the profit or loss for the year or period just ended. And unless it's the first period of trading, all of the above for the previous financial year. Thus, a comparison can be made year on year, but that's not necessarily enough to understand trends in the business. And for that reason, when we are undertaking valuations, we always summarise and consider at least 3 to 5 years' results. So, you received last night from Lakaya the accounts for a company called Birdie, which is a golf equipment manufacturing business. And you will see on each of the slides some notes and pointers in the box, and then a reproduction of the particular element of the balance sheet or profit and loss account and other areas that are included in those accounts. They're quite big and detailed, and with these slides we can pick them off as a snapshot as we go. So the balance sheet, which is the point in time summary of all the assets and liabilities, is a snapshot, and we can see for Birdie it's the balances as at 31st December 2017 over on the right, and then at 31st December 2018 on the left. And you can see all of the different assets and liability classes, which comes down to net assets, which were just over 5 million in 2017, and had risen substantially to 7.7 million in 2018. And at the bottom of the balance sheet, we get the capital and reserves, which we'll talk about in more detail in a minute. So at the top of every balance sheet sits the fixed assets. Those are pretty much what they say they are. They're fixed. They are enduring assets in the business, and typically for many businesses will include freehold property. But for Birdie, they don't have any freehold property. They must rent it to do their manufacturing. They do have plant and machinery and equipment. And you can see there that they have a cost at 31st December 2018, a total cost of 862,000 spread across equipment and plant and machinery. An important point to note is that all wasting assets like plant and machinery and equipment must be depreciated. That is, the value or the cost of that equipment must be amortized over its useful life. And therefore, once you deduct depreciation, you can see the net book value or the carrying amounts that are included on the balance sheet, which in total, as you can see, are 260,000. Intangibles are an interesting asset. You can see in the top left what sort of things are included in there. Typically goodwill, that's something that pops up, but other things like brands, intellectual property, patents, trademarks and copyrights. Very, very important things for particularly things like IT businesses, and also quite tricky to value. Sometimes people don't make the effort, but also there is a limit to what you can actually include, and the criteria is set out in the bottom left-hand box. Picking up on goodwill, that arises when a company buys another, and what it is the difference between the price paid and the tangible net assets acquired, and the difference is put on the balance sheet and called goodwill. And you can see for Birdie that they acquired somebody, and they've actually amortized all of it by the end of 31st December 2018. So what that means is it's been deemed to have no value left. Current assets, these are as typical stock, trade debtors and cash at bank. You can see over on the right the volume of these that Birdie had at the two period ends. Significantly, they've gone up between the two periods, and in particular cash at bank and in hand now stood, as at 31st December 2018, at just under 6.7 million. And you'll note that in the bottom right, there's in bold, we've put cash is king. And that is very important at the moment. With COVID, every business became very defensive earlier in the year about its cash reserves, up until the government made available more money by putting liquidity into the markets. But it also has an impact on valuations, in as much that those are undertaken on a cash-free, debt-free basis. So the cash of Birdie, if it was valued at December 2018, would be added as it is on the balance sheet. So here we've got in a summary of all of the assets of the business at the 2 points in time. There's some key points to consider. And the one I'd like to pick up on is investments. And you might wonder why that is when it's only £1 on the balance sheet. But don't be fooled, because investments can hide significant value. Birdie's has arisen because it acquired something and bought the nominal share capital for £1, but underneath could be lurking a very valuable trading subsidiary that's not recognised on Birdie's balance sheet. And Tom will pick up those aspects a bit later. So over onto the bad bits on a balance sheet, the creditors, the liabilities. You can see there for Birdie that they are nowhere near as significant as the assets, totaling less than 3 million. Trade creditors, you expect that to feature heavily in a manufacturing company, but an unusual item there is accruals and deferred income. And it's worth spending a couple of seconds on what deferred income is. It's defined down in the bottom right hand corner, and what it relates to is where a company has invoiced up front for the provision of services which should be delivered over time, and therefore they have to be deferred until the relevant accounting period they will be actually delivered. What you should find when you have a high deferred income balance is also a high cash balance, because where they've been invoiced and paid, they should crop up in the cash at bank figure. Again, we've summarised the liabilities. For Birdie, they're not significant. For many businesses, you will see bank loans, either in short-term creditors or long-term creditors. And it's important to understand what they are, what their covenants are, and what the impact are if they default on those loans. Similarly, for directors' loans, sometimes they can be quite significant. For many owner managers, they can treat their companies as their own personal piggy bank, and the accountants that look after them have to run it all through a director's loan account, which can produce a very large positive balance. But in this case, it's a creditor. So that's the top half of the balance sheet, as we call it, the assets and liabilities, and which then comes down to the net asset figure. And then at the bottom half, you've got the capital and reserves. They must balance. That might sound a bit obvious, but I've seen plenty of accounts submitted to Companies House that don't actually balance. In Birdie's case, you can see that the shareholders' funds have gone from just over 5 million to 7.7 million, which is a significant increase of over 50%, implying that the company was very profitable in the 2018 year. So on to the profit and loss account. That's the measure of the results of a company over a period of time. Typically it's a year, but it can either be a shortened period to that or even lengthened, often for tax purposes. It summarises, as you can see there, the turnover of the business, the cost of sales, sets out the gross profit, deducts the administrative expenses to leave the operating profit, which is an important line for us, which Tom will refer to. Tax comes off that to leave the profit for the financial year, which for Birdie was just 2.5 million in 2017 and 2.7 million in 2018. So turnover, obviously the sales of the business must be portrayed net of VAT. And set against that is the cost of sales, which is all the direct costs of delivering that turnover to clients. So that's wages, distribution costs and purchases. A key item for us as valuers is the gross profit margin. And we've put some notes in the bottom right there about that. Two angles there. One, the absolute gross profit margin of the business, but also, and more importantly for us, is the gross profit margin of the business against its industry rivals. You can see there for Birdie that whilst turnover has remained almost static, with a reduction in the cost of sales, the gross profit margin has gone up 2% from 39 to 41. So again, some key points there. These become very important to us when we're considering valuations, because the reality is when someone looks to buy a business, they're concerned about the risk that the profits that have been achieved by that business will be able to continue once they acquire it. So we are very interested to know whether the company is reliant on one or few key contracts or customers. Is there, it's not put on the slide, but is there significant personal goodwill? And is there dependence upon key staff? Is there recurring work or is it one-off? So further down from gross profit, we come to the administrative expenses. So for Birdie, it's 3.7 million and 3.8 million. And the temptation is to dismiss administrative expenses of little interest. But these are an area where we're very keen to have a full understanding. And what you will find with accounts filed at Companies House, which actually do disclose the profit and loss account, there is no detail provided for the administrative expenses because they're in the director's accounts, which aren't disclosed at Companies House typically. But administrative expenses include rent, utilities, staff costs, and advertising professional fees. You can see all the little bits there. And why are we so interested? Well, it's because that they are open to manipulation by the owners and directors. So typically for an owner-managed business, for tax purposes, directors' remuneration will be very low, and the owners will extract their remuneration by way of dividend for tax purposes. And when we come to do a valuation, we need to consider what's the value of the services provided by the directors, because if you are purchasing the business and replacing those directors with third parties, they would need to be paid a full market rate. Other things that are of interest will be rent. Sometimes people keep the property that drives the business out of it, do not include a market rate, or other items such as management charges between holding companies and subsidiaries or other members of the group can either be overinflated or underinflated to manipulate the profits. Interest payable and receivable, not very exciting, so I'll skate over that. Certainly interest receivable, virtually negligible in the modern world, and interest payable going up, but interest rates relatively low. But if there is a significant interest payable charge in a set of accounts, it means that the company is probably highly debt laden. So I've touched on a couple of these. Key points: are there any expenses not at market rates? Are there any one-off or non-recurring expenses? Again, quite an important point. In the current cycle, we've got redundancies going on or just about to kick off for many businesses. Furlough monies, we would regard that as one-offs, and we would adjust for all these non-recurring items to get back to the sustainable, maintainable profits. Within the accounts is typically a statement of changes in equity. For Birdie, it's quite boring. There have been no changes in the share capital, so you would see here if there have been new shares issued, and if there have been dividends paid, which haven't been in Birdie's case, they would show up here. So what we can see for Birdie is that literally in a 2-year period, the retained profits have gone from 2.4 million to 7.7. Cash flow statement, quite a detailed document, as you can see, lots and lots of numbers. But essentially what it does is it reconciles the profit for the financial year, which is the top number, down to the cash and cash equivalents at the end of the year, and how that has actually happened. So movements in non-cash items in the profit and loss account, depreciation, and then the investment in stocks and other debtors, or the payment or reduction in creditors or purchase of fixed assets. All of those things feature, and you can see there near the bottom there's a line about borrowings, so that would also feature. I mentioned earlier about what accounts being filed at Companies House, and this is quite a niggle for everybody really. Companies Act entitles people to file different types of accounts depending upon their size. The majority of businesses fall under the small accounts size. So you can see there in the top right hand corner there's a grid there which sets out the criteria which you need to qualify in 2 out of 3. It's the annoyance is, as you can see, that small companies are allowed to file filleted accounts which remove the profit and loss account and some of the related notes. I think it's important to remember that just because company files small accounts or filleted accounts, it doesn't mean to say it's not worth a lot of money, because although Birdie didn't do it, you could find that directors and owners withdraw a significant amount of profits by way of dividend, which will reduce the gross assets significantly. Therefore, they'll be able to get away and file small accounts. Basically, the bigger the company, the more disclosures have to be made, and you can see the criteria there. Notes to the financial statements. These follow after all of the detailed financial statements, and we'll just skate through these. Typically, the first one you come across is the basis of preparation, the accounting policies, that sort of stuff. Then you'll come on to some more notes which might generate some interesting information, and particularly one that will be of interest to you guys will be the related party transactions, seeking out whether there are other related businesses of a husband or a wife which have hitherto not been disclosed. So we're quite keen to look into those. They also disclose the level of turnover or activity between them and any loans from one to the other. Directors' report and independent auditors' report. These particular directors' report can be quite a useful source of information, because sometimes they get a bit showy and give away more information than they might need to. Often they will include the key performance indicators that the business operates to. There'll be a review of the year then ended, and maybe there might even be some information about what's likely to happen in the year ahead. The auditor's report. Larger companies need to have an audit. Any company can have one voluntarily. Most auditors' reports are clean, i.e. the auditors are happy with the accounts as prepared by the directors, but sometimes they're not. And sometimes that involves giving a qualified opinion. It could be relatively minor things, but requiring qualification. But if you see an adverse opinion, then that's a serious red flag, because the auditors are very unhappy with the accounts as prepared and feel there's uncertainty or a material misstatement. COVID-19 is clearly an issue for directors and auditors alike, and we'll touch on that in a minute. So going concern, accounts have to be prepared on the going concern basis, which means that the directors are anticipating that the business can carry on for the foreseeable future and meet its liabilities as they fall due. We've put in a few red flags there, which might bring into doubt as to whether the going concern basis is viable. And if the directors conclude that it isn't, then they have to default to the breakup basis, which will do two things. One, it will reduce the value of the balance sheet to the realisable value of the assets. The liabilities will stay as they are because they're at cost, but it'll also put on warning creditors and also clients. COVID-19 has brought a whole new level of uncertainty to the economic world, and for directors and auditors alike, it's going to be a problem. At the moment, the accounts aren't particularly filed at Companies House where there is much reference to COVID. Companies have typically 9 months to file their accounts, and they are at the moment entitled to apply to extend that to 12 months. Many companies have either a December or March year end, so we're not seeing those accounts being filed as yet. But when they start to become filed, they will have what we call a post-balance sheet event note in them, which addresses COVID-19 and the uncertainties that companies are facing. Clearly, this is different for different industries. Anyone in the travel and tourism industry is having a shockingly difficult time, but for others, it's no problem at all. And actually, COVID has been very helpful, IT and online. So that brings us to the end of the whistle-stop tour of accounts. As mentioned at the start, if you have any questions, please pop them on the chat and we'll try and pick those up. If they're super technical, we might have to take them away. We'll come back to you, but we'll do our best to pick those up. So I'll hand over to Tom now to do the valuations angle.
Thank you, Richard and Sarah. It's a pleasure to meet everyone, and I hope that you can all hear me and see my slides. As Sarah and Richard have mentioned, you will get copies of the slides, and there are some examples and reference slides within the material that I've prepared. I'll try and skate over the reference slides as they'll be there for your future reference. There is quite a lot to cover, so again, I'll pick up on the main issues, particularly the impact of COVID on valuations at the present time. So, what do we do? As the team specialising in business valuations at Creston Reeves, we're asked to value many different businesses, including different structures and across all industries. As well as traditional businesses, we've been asked to value other assets that can generate income streams, including intellectual property, royalties, and financial instruments, for example, preference shares and structured debt arrangements. However, the vast majority of our valuations are in relation to shareholdings. Our valuations are used for many different purposes, including regularly for matrimonial or other court proceedings, but also for mergers and acquisitions and tax and accounting. Understanding the reason for the valuation is key, not only in determining the output of our report, but also the motives for the valuation and the amount of information to be considered in preparing our report. Having considered the what and the why, we decide on how we're going to go about the valuation. There are many different valuation models in use around the world, varying from very judgmental to incredibly technical methodologies. However, three main methodologies tend to dominate. Those are listed in the slide here, and I'll consider these in more detail as I go through the presentation. The three main methodologies are profit multiple, often EBITDA, net assets, and discounted cash flow methodologies. Sometimes it's necessary, particularly when valuations are uncertain, to undertake more than one methodology and triangulate the results for confirmation. So, in most valuations, we're asked to determine either the market or the fair value of an asset. Fair and market value are often interchangeable. However, caution must be used when providing fair values, as this might be the fair value between parties or as defined in a shareholders agreement, as opposed to the market value that a third party would pay for the investment. Various definitions of fair and market value, and even fair market value, are shown on screen, and I'll let you consider these in due course. Again, I won't spend too long on this slide, which highlights some of the key points to be considered when starting each valuation. It is, however, worth noting that many valuations, while similar, are individually unique, and therefore circumstances particular to the asset must be considered for each one. This slide summarises some of the thought processes and examples of use and requirements for each of the main valuation methodologies. So the EBITDA methodology, it's often used for established, profitable trading SME companies. We'll need detailed P&L information to assess the sustainable profits of the business on a commercial basis. Then there's the net asset basis. This is normally used to value property investment companies or those companies with low levels of profitability, or even a breakup company. And for these, we'll need updated asset values, particularly in relation to properties. And then we have the discounted cash flow. This is often used for startup businesses or those in flux, but can also be used to value simple income streams, such as dividends and royalties. So let's consider each methodology in a bit more detail, using imaginary subsidiaries of Birdie. I've inserted examples into the slide which will be part of the pack sent out. The EBITDA multiple is the staple approach for many valuers in valuing SME companies. EBITDA means earnings before interest, taxation, depreciation, and amortization. So as you can see, this excludes the impact of depreciation, which can vary from company to company depending on the policy adopted. And it excludes interest as well, which will vary depending on the level of debt in each of the companies under review. This makes it a very usable methodology for comparing multiples between companies. The key steps for an EBITDA valuation are outlined in the flowchart on screen. But I'll move on to an example, and my first example is a subsidiary of Birdie called Robin. As you can see on the left-hand side, I've got summaries of the balance sheet and the profit and loss account. The bad debt exceptional expense in 2017 is shown as a negative in the profit and loss account. We can see that there's been an apparent change of depreciation policy between 2018 and 2019. And you can see that directors' remuneration in the last 2 years has only been £12,000, despite there being 2 directors. And this is for perfectly legitimate tax planning opportunities. And finally, as Richard mentioned in his presentation, this company uses a property, but it pays no rent for that property, so it gets something free of charge. So when we come to value the business, we've got this set out on the right-hand side. But first of all, going through the calculation of EBITDA. The EBITDA is a simple mathematical exercise, taking the operating profit, which Richard highlighted earlier, and adding back any items in interest, tax, depreciation, and amortization above that. Normally, only depreciation and amortization. So that generates the EBITDA of the business. We then have to normalize this for the profit, the EBITDA that an investor would earn on the business. So they would have to employ the directors, probably around about £150,000 a year, and they would have to pay a rent on the business, on the property. So that generates our normalised EBITDAs of between £180,000 and £200,000. From these, we assess the sustainable EBITDA, which is not always a straight average and will depend on any pattern in the EBITDA generated. To the sustainable EBITDA, we apply a multiple. We generate our multiples from databases of merger and acquisition data. The databases show comparable businesses and normally use an enterprise value multiple. In this case, the average is 6.5, but the deals are much larger. So we need to flex that for a couple of things. This company is much smaller than those in the databases, but it is growing. So we need to incorporate both these elements, and overall we've assessed a multiple of 5. The multiple can also be used to factor in other risks, such as Brexit, COVID, reliance on 1 or 2 customers, and other risks set out in the director's report. So going back to Richard's comments, It's useful reading the directors' reports for those risks sometimes. The product of those two numbers generates the enterprise value. And to generate the equity value, which is what we're normally instructed to opine on, we need to add on the cash and deduct the debt. So, one of the key advantages of the EBITDA methodology is that it does have comparable businesses. It strips out the interest and depreciation effect and makes comparable multiples comparable. But one disadvantage is it can be very difficult to find a sufficiently comparable transaction to rely on the multiple. This slide sets out various advantages and disadvantages and what we might need and when we might apply it, but I'll just slide over it for now. That brings us on to the net asset approach. The net asset basis is another conceptually simple valuation methodology. Simplistically, the value under this methodology is the summation of the value of all of the assets and liabilities disclosed or undisclosed, restated to their market value. Again, to try and bring that to light, I've set up an example of another Birdie subsidiary. This one is Starling. And on the left-hand side again, you can see the balance sheet and profit and loss account highlights. I'll start with the profit and loss account, and you can see it's pretty static, which is what we'd normally expect for a property investment company. And on the balance sheet, there's not really that much more to look at, except it's worth noting that the property is carried at cost of £2.5 million, but actually it is now worth £4 million. And there is no deferred tax disclosed on the balance sheet. On the right-hand side, we've got the net asset valuation. And this is a straightforward calculation. We start with the net assets, we adjust the property to its value of £4 million, and then we calculate a deferred tax element. Now, the full deferred tax on the potential sale of the property at £4 million, assuming it costs £2.5, would be a profit of £1.5 million or £300,000 of tax at 20%. But there's no certainty that that tax liability will arise. So as a valuer, we don't bring in 100% of the value. We need to make an assessment as to how credible, how likely it is that that liability will arise. And in this case, we've included half of that value. Now, Richard mentioned that Birdie had £1 of investment in subsidiaries. This approach in adjusting property can be used for the same way in adjusting investments in subsidiaries. Each subsidiary can be independently valued and then brought in to replace the £1 that was held on the balance sheet. And the value of an investment can significantly increase or decrease, depending on how it was acquired and what's happened to the company since. So again, another slide of advantages and disadvantages, but the main disadvantage is that it doesn't recognise future profits and therefore is likely to undervalue trading companies. The third methodology is the cash flow approach. We project free cash flows in future years and discount these to their current value at today's date. This brings those projected cash flows back to the equivalent value at today's date, assessing the risks associated with those cash flows. Here, the projections are very fundamental to the calculations, and they can be as complex or as simple as required. It's therefore a good opportunity to cope with businesses in flux and potentially those affected by COVID. Birdie's third subsidiary is called Fledgling. As you can see here, the history for the balance sheet and the profit and loss account starts in 2019, as it's a brand new company. The company's incurred significant research and development costs and has made a loss of £300,000 in 2019. But it projects rapid growth to around £800,000 where it will stabilise. So what we need to do from this is work out what the projected profit and cash flow of the business are. And from the cash flow, we then generate the free cash flow. And this isn't the same thing. For example, in this case, you can see there's £75,000 to start with. £80,000 of that will be used in 2020, giving a slight overdraft. And that means that in 2021, only 100 out of the £105,000 is free. And the final column on the left-hand side, the TV column, is the terminal value. This recognises the fact that most businesses will continue beyond the end of their cash flow projections, and there is still therefore some value to bring into the company for this period. Here we've used a simple EBITDA multiple based on the results in 2022 to generate that terminal value. Now on the right hand side, we bring down the free cash flow and the terminal value, and we apply the discount factor. The discount factor is one of the valuer's key inputs on this methodology. In startup companies, the discount can be much higher than this and can be judgmentally adopted. But in established businesses, it's more likely to be built up using assets such as the capital asset pricing model. I mentioned that Birdie had the £1 subsidiary investment and that this might be valued at different numbers. You can see that actually, if we had consolidated results for the business for Birdie, including those of Robin, Starling and Fledgling, it would be possible to create a consolidated valuation. The problem with this is, in Fledgling's circumstance, that we need a very different methodology because we're looking at the discounted cash flows in future. So it becomes important to assess whether we need to look at different subsidiaries of a company differently to get the full value out of the investment. Another slide of advantages and disadvantages. The key advantage might be that it's a very, very flexible methodology, but that brings with it a disadvantage in that the more flexible you make the cash flow projections, the more subjective the valuation becomes on the correctness of those assumptions. So that brings us on nicely to COVID. COVID is a very interesting problem for valuers at the moment and quite a challenging one. Most traditional valuation methodologies, including all of those previously mentioned, have either gone out of the window or need significant modification. Some businesses have been relatively unaffected, in which case the traditional methods may still be applied. Others have plummeted in profitability, while some have increased their profits substantially. For example, IT and some areas of healthcare we've seen. I'll quickly consider some of the issues arising with each of the discussed methods using updated examples for the subsidiaries. So EBITDA. As previously mentioned, this is a staple approach for trading businesses. However, it's likely to be the most affected by COVID. Traditionally, the EBITDA methodology relies on an assessment of the profits, the appropriate multiple, and adjustments for cash and debt. Now, all three of these elements are affected by COVID. So here's the updated model for valuing Robin. You can see on the left-hand side that the profitability and turnover of the business has plummeted, and this is reflected in the level of cash, which has dropped from £100,000 to £25,000. I'll move to the right-hand side immediately now. Valuation A is based on the pre-COVID equity value, as before. So referring back to the previous example, the £825,000 was what was generated there. And it may be appropriate just to discount the pre-COVID value for the impact that is seen in the stock market or other available indices, and to apply, in this case, a 25% discount to the pre-COVID value to assess the post-COVID value. There are issues with this, particularly in that small companies face different risks to large companies, and also that the further we adrift away from the start of COVID, the less relevant this methodology is. So an alternative might be to try and adjust the results for the impact of COVID. Now, that's not always possible because it's become so complex in some businesses with furlough grants and staff off and reductions in turnover that it just might not be possible to assess this. And another problem is COVID will have some permanent impact on many businesses and their profitability going forwards. So the past becomes less relevant in assessing the future. But assuming that we can come up with a COVID adjustment, we need to derive the multiple as before. But in 2020, can we rely on the pre-COVID multiples based on pre-COVID accounts? And in 2021, COVID multiples will become available, but will these now already be out of date? It may not be till 2022 before multiples can be treated as reliable again. So the next methodology was the net asset one, and this was very simple. So we'll move straight on to the example. Here you can see that yes, the profit and loss has been impacted slightly, and in the top half that the value of the company of the property has fallen from £4 to £3.5 million. Well, the change in the profit and loss account doesn't really matter because we're doing a net asset valuation, and we go through exactly the same calculations as before, but based on a £3.5 million property value. One problem with this, though, is that often for property companies, management information isn't quite as good as for trading companies. There's less importance to it. And so we're often relying on December 19 or March 2020 management accounts. And these will be pre-COVID. So we need to make sure that we've got updated information where we need this or management information to fill the gap between the two valuations. Now, the final methodology was the cash flow one, the one that is the most flexible for COVID. But this can only really be used if forecasts can actually be used credibly, prepared credibly, so that we can base our valuation on these. Here's the updated valuation model for this one. There's a bit more history for 2019 and 2020 shown in the balance sheet and profit and loss account. But you can see that the turnover fell in 2020 and is then expected to recover to the levels expected as before of about £800,000 by 2023. And this is achieved through additional marketing spend. So you can see it's very easy in this admittedly simple model to flex in these extra factors. Then we go through the same calculations of cash flow and free cash flow. We bring down the free cash flow and the terminal value to generate the total value of the business. You'll note that the discount factor that we've applied here has increased from 20% to 25%. And it might be that this is because of Brexit, but actually at the current climate, the underlying risk-free rate has fallen, but all the other elements of the capital asset pricing model are likely to have increased. So we're likely to result in an increased discount factor in assessing the value of this business. Now, there are some other problems with COVID. And one particular one is that COVID might create polar opportunities for a business. A customer might be expected to fail or succeed. A contract might be won or lost. And this can create two very different valuations for the business. And we might need to value the business twice and apply probabilities to these. Or in some cases, there may be many more scenarios and a more complex methodology, such as Monte Carlo simulation, may be necessary, where thousands of iterations of a cash flow are run to generate a full range of possible outcomes. Well, that's for another day. So, is there an answer to COVID? Well, as demonstrated, I suspect there is not one, but there are many different answers. Previously, valuation was subjective, particularly around the selection of the model and the multiple and discount rate adopted. But now there will be far more uncertainty in the underlying model, in the discount rates and multiples, but also in how we adjust for COVID. And it may be some years before we can forget about COVID. While this does not mean it's impossible to value businesses, this uncertainty must be disclosed in the reports to make sure that the user of the valuation understands its implications. What is important is that we don't double dip the discounts. For example, reducing profits and the multiple and then deducting a provision for getting through COVID may potentially result in discounting for the same effect 3 times. What may be necessary now, therefore, is the consideration of multiple methodologies and the use of triangulation to reassure our valuations. Now, I had hoped to skip through a couple of other valuation matters, but I see that we're sort of coming up to 10 minutes to go. So I'll just very, very quickly mention these rather than spend any time on them. These are other issues that we face as valuers with traditional valuations. We've got the difference between enterprise value and equity value, which is something I touched on earlier. We're often instructed to provide an equity value, but our databases generate enterprise values. Then we have the minority interest discount. A minority interest discount is normally applied in valuing minority holdings to reflect the fact that they don't have any control over the influence and operations of the business. For example, a 5% shareholding in a company may be worth only 1 or 2% of the total gross value of the company. We also get asked to consider quasi-partnerships. If a company is treated as a quasi-partnership, then the application of a minority interest discount may be irrelevant or reduced. And we're asked to consider the tax implications, typically as a result of the proposed transaction for which we're providing the valuation. For matrimonial cases, we can comment on liquidity and capital raising and maintainable earnings for the assessment of maintenance payments and the like. And also often in matrimonial cases, we look at accounts reviews and asset tracing. Are the accounts on which we're actually basing our valuation credible, or have these been suppressed in any way? Have assets been withdrawn and hidden elsewhere? And then the final common recurring theme that we look at is the information standard, normally relevant to tax matters, but this is the amount of information that a hypothetical investor in the company would reasonably be entitled to see given the size and likely value of their potential investment. So I'm sorry I've had to skip through the last two, but that brings me to the end of my bit on valuation, and hopefully we'll have time for some questions. So I'll pass you back now to Sarah, and hopefully we can answer some of the chat questions that have come through. Thank you for your time, and speak to you soon.
Well, thank you very much, Richard and Tom. That was extremely helpful and suitably detailed. And I'm very glad to be able to have the slides to take with me. So please do think of questions, everybody. I have a couple that I can start with. So the first thing is really a question for Richard, because you specifically mentioned it and we discussed it, that you're interested in being shadow expert and that your experience in that is something that you've enjoyed. I just wondered if you could tell us a little bit about that and why you think it's so valuable for people.
Well, okay, I'll actually refer to a specific case that I was involved with, which ultimately was really quite disappointing. So it was a client of the firm who was obviously involved in a matrimonial divorce, significant amount of assets at stake, and there was an SJE that had been appointed and had taken 2 years to do his report. He charged the parties the thick end of £20,000 for it, and it was rubbish, sadly. And the reason why it was weak was because he'd failed to value the underlying business correctly. So there were a number of businesses that the parties had. Predominantly they were property, which would have been on the net asset basis. But what I was able to do was to advise our client as to the merits of the report undertaken by the SJE, and as a result, I made it very clear to my client that the valuation for the trading business was very low, and had been fundamentally calculated wrongly. The reason for that was that there was a trade and also there were some assets, intercompany balances. It's a bit too complicated to go through how that worked, but suffice to say that it was undervalued by well over £1 million. Therefore, that became very important in terms of how it was approached, in terms of questioning to the experts, and ultimately how it was dealt with at trial. Unfortunately for my client, he didn't get that business. but nevertheless, I could bring to the table the issues with the report and help counsel QC to formulate appropriate questions, which were largely done through questions outside of the hearing. But ordinarily, I think it's vitally important for a party to, when faced with a techie report from an expert, as to what that really means, because although we try, or most of us try very hard to prepare reports which are devoid of much technical jargon as possible, it's impossible, and it's vital that a party understands the strengths and weaknesses and what can be achieved. Tom mentioned that one of the questions commonly put to experts is capital raising. And it sounds quite easy, but it's not. As an external expert who's not involved in the day-to-day workings of a business, it's very difficult to work out what can actually be raised in the short term. And in that particular case that I referred to just then, the expert was asked that question, and he suggested that there was spare capital, but that required the company to go into overdraft at 2 points in the year, which I thought was absolutely bonkers. So all of these things can be covered off by either by the SJE, but if it is very complicated, then and there is significant value at stake. I understand proportionality and all that and why SJEs exist, but the reality is a shadow expert can really quite quickly get to the nub of a complicated and technical report and give the parties or one side a better understanding.
That's really helpful. Thank you. We've had a question from Jason Varney. It's probably a question for Tom. And he says, very helpful presentation, thank you. To what extent is Brexit having an effect on current valuations of SMEs? Presumably your models will largely depend on whether the relevant SME has a European business.
Thank you for the question. Hopefully you've got me. Yes. To what extent does it depend on whether we've got an SME business? We would do our research on the databases, and in this case, what we would be looking for is comparable businesses with a similar structure, both over in Europe and in the UK or wherever the businesses are. That obviously makes things harder because you're then not just setting parameters about the industry that you're looking for, but the structure and geographic location of it. But that's the ideal world. We'll find something as comparable as possible. Beyond that, it's a case of saying, okay, well, we know we can see the impact of Brexit on multiples generally within the UK. So that element's already been factored into the multiple database that we are seeing. But is our valuation target more susceptible to Brexit as a result of this? So that's understanding the business and whether it's a net importer or a net exporter, or whether it's exclusively in Europe, in which case the risk almost goes away. And we've dealt with a valuation where all the clients and all the customers were in Europe, but the company was based in the UK for tax reasons. So that actually had less exposure than those where we are importing into the UK and dealing with it there. There may be a second problem to this, and I go back to one of the points in my presentation. This may be a circumstance where actually we need to consider the valuation if Brexit goes well, and if Brexit doesn't go well. It might be that the customer, again, we'd have to investigate further, that the target has a customer in Europe that might disappear because of Brexit. And in that case, we'd have two very different valuations for the business. So that might be another way of addressing the issue. It's, without knowing the detail of the exact, structure of the business, it is very difficult to say how we would cope with it. But certainly we'd be looking for as similar a business in our multiple research as possible, and then making adjustments based on that.
Thank you. And there's so much uncertainty about everything at the moment, makes life very difficult. There isn't another question from anyone else, but I just wondered if you could just deal with this practical point. Obviously, people involved in finding experts for matrimonial finance cases have to deal with letters of instruction and identifying experts. And I just wondered from your experience if there's any sort of bugbears you have about letters of instruction that you receive, anything that you'd like to see in there or that doesn't need to be in there.
Shall I start on that, and maybe Richard will follow up on that? We do get letters of instruction, and I think that the common theme that we find with those that are slight issues are where we've been asked a quote for one particular instruction, and we've prepared the quote for a particular assignment. Normally, it's a valuation exercise, and it might not mention capital raising or revenue generating. But then when the letter of instruction comes through, 3 or 4 or 8 or 9 different additional instructions have been added to it. So just recently, I had one where it went from being one valuation to being 2 valuation dates and 2 different assumptions around the properties within the business. So that means that we obviously have to go back to the client and say, actually, it's going to cost a bit more, and you then have to go back to your client and say it's going to cost a bit more, and it's just a bit unfortunate, let's say. Now, I understand that often these things evolve over time, and actually, the requirements change, and so you might not have exactly the requirements when you first approach us, but that can be tricky in terms of addressing the ultimate client's expectations. So that I think is my main bugbear. I don't know if you've got anything you want to add there, Richard.
Thank you. Hopefully you can hear me, everyone. I think just adding to Tom's comments there is obviously every case is different and depends upon the assets and company structures and all that needs to be debated. But I think the one thing that I think is very important for us as valuers is that we're given enough time to do the job properly. Yeah, so we I see court orders where it's expected to give the expert its instructions by a certain date, and we get on many occasions they appear after that, and then we're asked to fill the time in or get back on track in time for the hearing, which is very very difficult because we often need to ask more information from the company's accountants, and that obviously takes time to turn around. So my plea on behalf of all experts is give them sufficient time. What does that mean? That probably means 4 to 6 weeks. I can remember one case where I've been appointed as an SJ, still isn't done actually, but we were asked to turn it around within 2 weeks, which was very, very difficult, and we put a lot of pressure on the husband's accountant.
It's more the administration points of the letter that we have the issues with.
Yeah. Well, I think on that note, thank you very much for that. I think it's something that we'll all be able to take back and hopefully not annoy our experts with short instructions.
I didn't want to end on a negative, so it would be nice to sort of come up with something. But we obviously always enjoy working with people, but it's nice to meet new people and take the instructions.
That is a very positive note. Well, I'm going to say a huge thank you to Richard and Tom for everything that you told us this morning, and thank you to everybody for joining us. We're just after 10 o'clock, so enjoy the rest of your day, everybody.
Thank you, everyone.
Thank you.